What's good, everybody? It's Jonah. Come back at you with another video. So for this video, I'm going to be doing a breakdown of Monday, August 3rd, 2026. So for those of you who are new here, I typically don't trade the entire month of August just because I was told, and I've heard also from many traders that the month of August, one, is typically slower. And it makes sense, right? A lot of people are on vacation, a lot of people are traveling, right? Not as much movement in the market. But two, I was always told that during this month, that price has a tendency to not deliver as cleanly as other times throughout the years, right? That certain setups that you think might be there may not deliver as expected. So it can result in losses or greater losses, right? And I've seen many traders that, you know, they could typically have normal months, and then when they arrive to August, that's when they typically have like a losing month, right? Because price doesn't move as they would like or as they expect. So normally I sit out during the entire month of August. Now, I do have a vacation plan um, towards the end of this week. I'm basically going to be going for like 2 weeks. So that's going to be almost 2 to 3 weeks of August already there, right? Well, I won't be behind the chart. So the month is going to fly by pretty fast for me, which is a good thing. However, what I'm going to still do, like as a trader, I'm always endlessly curious. So what I'm going to do is, even if I'm not going to take a trade for the duration of the entire month, I'm still going to go through each individual day to see what happened, right? Because I'm always interested in collecting data and more evidence from what took place on the charts, right? So even though on this day I did not take a trade, right? So if you're watching this video, the title is going to say NT in brackets, which means no trade, right? Did not take a trade on this day. However, I was behind the computer, just interested because um, my normal setup did play out, and the funny part is it did deliver to the T. So the first legitimate trading day in August, it actually delivered on my setup, right? So once again, even though I didn't take a trade on this day, this video can still provide you with a lot of valuable knowledge and information, right? So jumping right in, the Forex Factory, obviously, because it's the first week of August, you see that there's NFP on a Friday. So normally the rule of thumb that I have is that for NFP weeks, I typically only would, look to take setups Monday and Tuesday of NFP week. But once again, it's August, so I'm not going to be pushing any buttons, right? At most, I'm just going to be um, tape reading, right? Watching price and just seeing price deliver. That's the most that I'll be doing for this month, right? So on Monday, you see that we have a news event, right? And so we have that at 10, so that's important to be aware of. However, not much else. So jumping right in, right, the first step we like to take is determining the higher time frame bias, right? Which direction is price most likely to go, either up or down, right? It's just that simple. So if you look at let's do the NAS first, right? If you look at the NAS, most people think that price is bearish, right? Which is understandable, right? If you look at the prior day, you see this aggressive move, right? This wick that came and cleared price, right? It cleared this high with this wick, and then price went straight down and blasted through these lows, right? And it left a low down here. Now, for most people, they'll see this range, see that the range hasn't been broken through on either side, right? Because obviously this high is not higher than this high, and this low is nowhere near being touched, right? So most people thought, or most people approach this day with a bearish bias. However, my bias shifted when I looked at the S&P, right? So here we have the S&P, and you're seeing that S&P had a big push to the upside, and you're seeing that this was the high that was formed. Now, this high right here does in fact get taken out by this high, right? And I'm going to show you, right? You're seeing clear as day that this high got traded through. And when this high was made, the previous low was this swing low right here. So this structure break to the upside happened. This black candle right here, this last candle right here, this candle, this is the 7 a.m. to 8 a.m. So this is pretty much where price is at 8 in the morning. And the structure break happened right before 8:30. So my rule of thumb when determining higher time frame buys is whichever price gives me the most out of the two pairs, whichever gives me the most recent break of structure prior to 8:30, and um this happened at, I guess you could, between 7 and 8 in the morning, so right before 8:30, right? So this gave me the confirmation that I was going into the day with a bullish bias, right? So now get rid of that, right? So because of that, right, because S&P gave me a sign that we're bullish, so I am bullish for my buys for both pairs, right? So now we'll skip to 8:45. Okay, so this gold candle right here, the tiny gold candle, right? We look at the S&P, this tiny gold candle, this is the 8:15 to 8:30 candle. So now if we look to left, where is the most recent swing low, right? It's obviously right here because this is the candle that formed at 8:30. If we look to the left, right, obviously this is an obvious standalone swing point. So I'll mark it red because under here is what? Sell side liquidity, right? If price goes under here, a lot of sell stops get activated, and this is where we would look to buy, right? Because this is where price usually tries to get their buy orders before pushing price higher, right? So that's the logic there. The same idea with the NAS, right? If we look at this small gold candle in the middle, this is the 8:15 to 8:30 candle. So if we look to the left of 8:30, the most recent swing low is right here, right? This is a standalone swing low, obviously clear as day, right? Now at this point we have our point of interest mark. Now we want to mark our targets, right? So where are our upside targets? So at the very least, right, this is the most obvious target for the S&P because, you know, this high was already taken out with this high. So this is the most prevalent, closest, easiest target for price to reach for. However, this is only one target. So because we don't have anything else, that's when we'll go to higher time frame to see if we can find anything else, right? So if we go into the 4-hour time frame, we're not seeing many other highs other than this high all the way up here, right? Let me see if we go into the 1 hour. Okay, so 1 hour time frame, you're seeing another high right here, right? So I have a few additional targets marked, right? If everything goes in our favor, if price goes under here, right? And then, you know, we're able to take price higher. I guess in a perfect world, we would love for price to go all the way up there. Now, of course, you don't expect it to necessarily happen, but you know, we can hope that price might want to make its way up there. Now, going into the S&P, right? So S&P, if we, you know, let's go back on the 15-minute time frame, right? So remember, we are bullish. So where is the most obvious extreme, right? Of course, it would be here. Why? Because this is practically, well, this small bearish candle right here, this is midnight open. So this is basically the high right before midnight open. So we can say that this is pretty much the high of the day. And then obviously you have the other high up here, which is the wick of Friday, right? The last trading day prior to this session. And then you have other targets if you want to, you know, potentially go for any other additional targets, right? But these are the main, me personally, right, on this trading day, I would look to target this high right here because this is one of the most recent and obvious external liquidity points, right? So you're gonna have internal and external liquidity, right? Internal liquidity would be something like this, would be like this fair value gap right here, right? Let me zoom in. Might be a little hard for you to see, but as you can see right there, you're seeing that there is a bit of a fair value gap, right? That would count as internal liquidity because that gap right here, this falls within this range from this high to this low, right? This is, you know, one of the targets on the inside. However, this low and then this high, these are the extremes, right? Because the highest point and the lowest point, right? So that counts as external liquidity. So this, at the very least, I would look to close off at least 90% of my position because if I want to leave a runner to try to go even higher and ride the trend, right, of price potentially wanting to go bullish, then I'll do that. But at the very least, right, I'm closing at least 90%, if not 100% of my position up here, if price is able to go there, right? And then, you know, obviously you have some other targets here, right? You have another high here, another high up here, more highs, right? So the same logic that we use to find entries And to trade is the same logic we use for our targets, right? Because we expect price to want to reach for the previous highs, right? We have another high right here, right? So we have plenty of potential options if price is in fact bullish and wants to go up where we want to take it, right? So you guys, get the idea, right? So now jumping in, we can jump in to the 1 minute time frame, right? I know there's a lot of lines, but just please, for the time being, disregard it a little bit for the NAS, right? So here we go. So we have our, point of interest mark. So we want to see price go in and attack that liquidity and ideally make the low of the session, right? Because this right here obviously is the low of New York, right? This brown background right here, all this brown, that is the New York session. And we want price to go under this low, which would make the low of the day so that we can take it higher, right? Same idea with the S&P. This is the low of the session. So price were to go down, we look to try to take an entry, right? And then be able to take price all the way up because we are bullish. So if we're bullish, we want to buy at the bottom, right? Buy low, sell high, right? That idea. So now we're at 8:45. Now we'll just watch price to see what happens, right? So now it's 9 o'clock. Nothing's really happening, right? You're seeing prices kind of consolidate for both pairs, right? So no big deal. So we just continue watching price to see what happens. And then we want to just let price play out a little bit until we get close to 9:30. All right, cool. So you're seeing out of nowhere at 9:25 to 9:26, you're seeing aggressive bearish momentum until this gold candle right here. This gold candle right here, this is the 9:30 open. Now, this works out in our favor. Why? Because remember, we are bullish. So we want to see a push lower. And because this is the 9:30 candle, right? The gold candle is 9:30. This candle made the low of the session, right? Because clearly this candle's low cleared this candle's low, right? You're seeing the two lows, right? So technically speaking, price did in fact make the low of the session at 9:30, which means at this point, right, all of our confirmations are being met, right? That's like a low check mark, right? So everything's good right there. Same idea with the NAS, right? Price begins going down at 9:25, and then this bearish candle right here is the 9:30 open. As you can see, the 9:30 open is the candle that clears this liquidity our point of interest. So now, right, I want to see bullishness, right? I want to see, right, you see a bullish candle form with the S&P. I want to see bullish candles continue forming until the previous swing high, which right now, this point right here is the previous structure point because it is a swing high, right? So price will have to go all the way up and break structure now. Based on just these two setups alone, the reason why I'm leaning more towards the NAS compared to S&P is because the NAS100 has a lot more upside potential. What do I mean by that? If the S&P, if right now the last structure point is up here and our final target is up here, right? Then it's unlikely for price to go up, break structure, and then give us a good entry to then, go up and clear this high, right? Like this structure point is so far away from the bottom that if price were to break structure to the upside, I would expect price to just continue going and clear this target. Remember, we want to enter price at the bottom somewhere, you know, at the bottom somewhere, so then we can take price higher. But if the structure point to break structure is up here, then chances are price might want to move so aggressively and then, push past this final target. So if we think about how different the NAS is, right? If I go on the 15-minute time frame, look how different it is, right? S&P, the break of structure is really close to the high of the day. Whereas if the NAS were to break structure, right, structure will be broken somewhere at this level potentially, and then we can ride price all the way up here towards the final target. So in my mind, right, where both pairs stand, most of my attention is on the S&P because it has so much more room to continue moving up, right? So if we skip one more candle, boom, what are we now seeing? Clear as day. Boom. This right here is the most recent swing point. So on the 1 minute time frame, if price were to go up, I would need it to break structure here for me to look for an opportunity, and right, because this is the displacement high and this could potentially be a displacement low. So a fair value gap, we want a fair value gap to be somewhere within this range to then take price all the way up, right? So this is what I'm thinking, and I'm going through the process candle by candle. Right, you're seeing already with the S&P what happened. The S&P cleared some liquidity and it's pushing up. So remember, the previous swing point is up here, so it's unlikely that we'll get a setup unless S&P decides to go down again and clear the low and give us another opportunity. So now, right as I'm watching the NAS, right, you see the NAS made a push lower. Obviously, it made a load session, and then this is the first bullish candle after the liquidity grab. So at this point, I want to see consecutive bullish candles, right? Gold candle, gold candle. I want to continue seeing gold candles nonstop until this high right here gets traded through, right? Because then to me, that is what counts as displacement. That tells me that price is aggressively moving up and is very probable to continue wanting to go higher, right? You want to see that aggressiveness. Boom, right there. This is what I'm looking at, right? This entire push up, just this is price literally exploding to the upside. Now, the next rule is that I want to see a fair value gap appear within this range. Now, of course, you have a fair value gap right here, right? And so I want to see if any fair value gap is going to form within this candle that's going to fall within this range, right? So we're gonna skip one more candle. Boom. Okay, so it does not. So let me highlight it for you guys, right? So this is the displacement high to displacement low, right? This pink. And now, according to the rules, we need a fair value gap to form within this range. The whole fair value gap has to be within this range. Now, of course, some people will look at this fair value gap, but this would not be a valid one for the strategy because this you're seeing some of the gray shaded areas falling outside of the pink. So this would not count as one of the valid fair value gaps for entry. This would be the entry that we'd be looking for on the 1 minute time frame potentially. Now, the other thing you need to be aware of is that, I'm seeing that price not only cleared this high, but it also went higher and cleared these additional highs. So that tells me potentially that price might potentially also give us an opportunity like a setup on the higher time frames. Now, my rule of thumb is that if price is giving, multiple entries on multiple different time frames, right? Then typically, like if there's an aggressive push up like this, then typically price might want to enter on a higher time frame. And I'm going to show you, right? So this would be our entry on the 1 minute time frame that we'd be looking to take. However, I also scan through the different time frames. Now remember our rules, right? From the displacement high to displacement low, right? Once we see a structure break, right? There is no gap on the 2 minute time frame that falls within this range, right? Because the fair value gap on the 2 minute time frame is from up here to down here, and this would not fall within the square, right? It would not fall within, well, in this case, right? Pink shaded, right? That's the displacement range, right? You see the gap doesn't fall there, so there's no entry on the 2 minute time frame. So 2 minute time frame gets ruled out. We have a potential entry on the 1 minute, but 2 minute time frame gets ruled out immediately. Oh, and as you can see, right? Sorry, I wasn't paying attention. See the S&P went up and cleared our target, right? So it literally didn't even give us an entry, right? It left a fair value gap here, left a fair value gap here, right? There's no gap here, and then price came and took our target. So there's literally nothing we could have done on the S&P, right? So that's why all of my attention eventually shifted on the NAS because there's so much more opportunity and upside. So, right, we have potential 1 minute gap, right? Nothing on the 2 minute because it doesn't fit the rules. Now on the 3 minute, this is not a break of structure, right? However, on the 3 minute time frame, this right here is a previous break of structure, and you're seeing price does in fact trade through, right? You're seeing a bearish candle, and then that bearish candle took liquidity, then a bullish candle up, and then another bullish candle up back to back, leaving a fair value gap, right? So on the 3 minute time frame, right, we look at the displacement range from the high to the low, right? High, low. We need to find a fair value gap within the range, and we do find one up here. So now, here's one thing to consider, right? Of course, if you were to try to take an entry on the 1 minute time frame, you would have a much better stop loss, right? A much better risk reward because your stop loss is like much smaller. However, there's no guarantee that price is going to go down there because remember, right? We think of trading as the game of probabilities. It's more likely for price to come up here and tap this gap than for price to tap the 1 minute gap somewhere down here, right? Like that's just the reality of it. In order for price to get down here, it needs to pass through here, and not every time price is going to make it to the deeper retracement gap, right? So once I seen this and an opportunity appear on the 3 minute time frame, um, I was sort of expecting that price was going to want to tap this gap and probably not make it lower, right? So at this point, this is where you would set up your long, right? And think about all the confirmations we have. We have higher time frame bias, which higher time frame is bullish, right? From the S&P. So we have the higher time frame bias on our side. We have a liquidity grab, right? Because this push down cleared this liquidity gap. We now have a break of structure, right? Because this gap, got broken through and price pushed above it, right? We have a fair value gap, which we know fair value gaps are the actual support and resistance, right? These are like magnetic areas for price to want to tap into. And then we have, you know, reasons for price to want to go higher, right? All of these previous highs, right? For price want to travel there. And then, of course, we have the fair value gap that was formed within the displacement range. So you're seeing all of the confirmations basically being met with this trade. So here I have my potential entry, stop loss below the low. Of course, you have your high up here, right? This would be to the highest high of like to the high of the day, right? This is about a 1 to 2 risk to reward, right? So this is what I saw unfolding in real time. And then if we just, play it out candle by candle, you're seeing right there that price does tap the fair value gap, and you're seeing signs of rejection, right? You're seeing prices just wicking it. So price is going down, tapping it, and then it's continuing to push higher. And so, right, you're seeing price kind of consolidate a little. And then this was the push up that we wanted to see that clear the first target. So this target is for about a 1 to zero point 0.8. So I guess you could close like 20%. I would, close like 20% of my position, right? Just to start taking some partials, and I would still leave my stop loss like where it's at. I would want to see a larger move. I'll move my stop loss closer to 11, or I want to see a larger high get taken out. And then boom, right here, you're seeing another aggressive bullish candle up that clears this high and makes it close to the next target. So at this point, right, this is a pretty important high that gets taken out as well. So this is a 1 to 1.23. So at this point, you could probably take off like, you should at least have like 50%. Me personally, I would have at least 50% of my position closed, right? And then you're seeing a little bit of a pullback, and price just, right, continues going higher. And then once again, you're seeing more highs get taken out. So then you would close like 80, 90% of your position, right? Because you want to be taking partials along the way up, because so many times as traders that they just have their mind made up that they're going to hold for full target each and every time. And while you still can succeed doing that, you're better off taking partials, because then if you take off partials, you eliminate the need to be right every time. And even if at this point, let's say you didn't roll your stop loss to break even, if price were to reverse against you, then because you took off so many partials, it's like if price reversed against you, you still be profitable and everything will still be fine. But if price stopped here, if you had your final target here to take it to full TP and you didn't take any partials and you didn't move your stop loss and price reversed against you, you would turn a winner into a loser, right? And you don't want that, right? You want to consistently keep growing your account and compounding it. So I would have taken at this point, definitely I would have closed off 90%, at least 90% of my position. And then as you can see, price does eventually blast through. Now, if you had additional targets, right? Say, for example, if you had a target up here, obviously price also traded through that target as well. And like this is, right, if I leave now, you're seeing where price is at right now. Like this is, as of this recording, was it 3:39, let's say almost 4 o'clock, which almost like when the market would close, getting close to the close of the day, right? You're seeing that price travel its way up to the point where it's a potentially a 1 to 4 risk to reward. So, excuse me, even if you wasn't fully content with these targets because you had a large stop loss, price still continued traveling in your favor. So you could have potentially held a runner. Like if you held like a small 10% runner or something, you could have, eventually trailed your stop loss, right? Could have your stop loss here and then under here and then right, like you get the idea, right? So you could have also still continue making profit by having a runner or, managing the trade how you like. So if I remove the full screen, you're seeing what also happened with the S&P, right? The S&P, what happened? I mean, it didn't give us an entry. Well, it technically did on like the 3 minute time frame, right? I mean, if I get a little closer to zoom in for you guys, right? On the 3 minute time frame, what happened? Price blast through, break structure here in the 3 minute time frame. It left an obvious gap within this range of this low and this, oh, sorry, of this high and this low, right? That is our displacement range. You can see price tapped into this fair value gap right here, and then it blasted through. But the reason why I would not be interested in taking the S&P over the NAS is because this would be the high of the day that gets cleared immediately before we get our entry into the fair value gap. And yeah, there's no guarantee that price would want to have continued going higher the way that it did. But as you can see, price does in fact blast up, right? So let me get rid of all these lines. I know it can be like a little distracting, right? So I'm showing you guys this because I want you guys to continue with, seeing this with your own eyes that this is what's happening, right? If you've been following my channel for the past several weeks, like ever since my return back on YouTube in like July, right? I've been showing you guys this phenomena that continues happening, right? And you get to see with your own eyes, definitely every week, but almost every day, that in many cases, right, after 9:30 open, price typically does a fake rally or a fake move, right? After 9:30, you see that price went down and made the low of the session right here. After 9:30, price went down and made the low of the session, and it cleared liquidity, right? This move here is clearing sell side liquidity. Why? Because we're bullish, right? We're bullish. And price, because price is controlled by a machine, is controlled by an algorithm, by a computer program, right? It's not up for debate, right? Because like if price was truly free flowing, then we wouldn't be seeing like this level of precision, this level of accuracy, and this level of delivery. The only logical conclusion you must arrive at or to is that everything is controlled and manipulated, that this is all being moved by a machine. And you're seeing this, that price has the tendency after 9:30 to make the fake move, right? It went down, right? As price opened around 9:30, it pushed down to get traders to think price is bearish. And so there's going to be a lot of traders that's going to sell, 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 trying to catch this momentum of price, right? And then there's also a lot of sell stops under here, which a lot of traders they put sell stop orders under lows because they're expecting if price goes under, that price is going to continue moving lower, right? And traders use sell stop because they want price almost to like prove to them that it wants to go lower by pushing under for them to jump in, right? Or think about traders who are trading breakout, right? They see this bearish candle forming under what most traders would consider to be support, right? They see price is blasting under, and so breakout traders are going to go short right here, not knowing that price is doing that because it does in fact want to go higher. And let me show you what is in fact happening, right? So you guys can be able to, see it visually. This is what's actually taking place, right? When price dips under the liquidity, it's doing this, right? It's buying, right? We need to think of the market as like think about human instinct and human behavior, right? Most people when they see price going down, they see the market going down, they think It is bearish. They think it is tanking. So most people are afraid to buy. Most people are scared to buy when it's at this point because price is too low, right? They would much rather buy up here because most traders, right? Most traders trade support and resistance, right? And so they'll wait until price is up here to then buy because they want price to prove to them that it's bullish. But what the market is doing, what the machine is doing, it's going under these lows to activate sell side liquidity, to activate selling orders so that the market is flooded with sell orders so that it can serve as a perfect counterpart for them to buy down here and then take price where they want to go higher. And then when they, push price to where they want it to be, right? Then at this point, they will freely sell. So the orders that they were able to accumulate down here, right? All the buy orders that they were able to accumulate, they brought price up here, above these highs, up, sorry, above these highs right here. That's where they're gonna sell. They sell the orders that they bought, right? And that is how you need to think of trading. You need to think of trading from the lens of liquidity. You need to think of trading from the lens of orders, right? Order pairing. That's a trade is an exchange. You need two parties, right? So buying and selling, you need two parties in order to pair. So price, when price is bullish, it has a tendency to first want to go down first, right? Which you see here, right? Price went down first before moving up. So I'm showing you guys this because this is the market. This isn't my opinion. This isn't what I think. This is what the market continuously shows us time and time again, week after week, because this is the market. This is the behavior. This is what it does. And it's going to continue repeating. And if you don't know it or you don't understand it, then it's probably going to continue taking advantage of you. But the traders who do understand it and begin seeing it for what it actually is and what it's actually doing, that is when you're finally able to capitalize, right? And you're seeing that, sure, I didn't take a trade on this, and sure, there's going to be some people might say, oh, well, it was easy for you to say because it's hindsight. But what you need to understand is that I was looking at price unfold live, and I put this fair value gap, and I put, this long tool and everything, right? I had this set up while this was happening live, right? I just not going to trade in August. On top of that, everything that I showed you is literally in alignment with the strategy that I've been repeating for the past several weeks, right? Everything checks out. Higher time frame bias and all of my rules that I follow checks out with this, right? So I'm not changing anything up. I'm not switching up anything of my rules on my strategy, you know, just for this video to make you think that I know what's going on. It's these are the same exact strategies, like the same exact rules that I've been following this entire time. And you're seeing it play out exactly to the T, and it would have resulted in a win even in August, right? So I just wanted to show you guys this to show you guys that, you know, this is what price is doing, right? Price is going under these lows to then buy and accumulate buy orders. Um, and then of course price pushes up, and we know, it left the fair value gap because price pushed up so aggressively. Now price is coming back. It taps into this gap, right, to close it off, and then it continues pushing up higher until it ultimately, clears at least the high of the day, but it continues going way past that. So just what you notice, what you will come to notice with the strategy is the fact that you'll begin noticing that a lot of your entries will be close to the bottom, right? Like you are taking a buy position down here and you are able to sell price. I mean, at many points all throughout, but ultimately for a final target or most of your position, right, to get rid of it up here. You're not, buying price up here, hoping that it moves a couple pips up there. No, you're buying it at the lowest point, virtually well, I mean, you buy here, but you're buying it virtually at the lowest point of the day, at the bottom of the day, and you're able to take price, you know, potentially up until market close, right? And this is the major paradigm shift. This is how you're going to succeed in trading, by getting your directional bias correct and then being able to ride the wave and trade in alignment with the trend. Because as a trader, you will never be able to control the market, right? You will always be at the mercy of the market. So you have to get in line with what the market wants to do. And whatever the market wants to do is what it's going to do. And you as a trader, need to fall in place, because if you decide on today, which was a bullish day, if you decided, oh, well, I feel like being bearish, then chances are it'll lead to you taking losses, right? Because the market is bullish. And why would you want to trade against the market? That doesn't make sense, right? So hopefully you found value from this video. Hopefully this video makes sense, and hopefully you guys appreciate these breakdowns, because shout out to some of the people that have been leaving comments saying that this has been very clear and helpful to them. And so that's what I always aspire to do, to help make trading simple, right? And to have it make sense in your mind so that you can do this on your own one day. So I rest of the video. You enjoyed the video, leave a like and subscribe as you're on the road to big million subscriber, guys. So once again, it's Joel, and I'm out. I'll see you guys for the next video.